Good morning, everyone, and welcome back to Future Finance Lab. Today, markets are opening under the shadow of war and rising geopolitical uncertainty. These are the moments that remind us of one of the most important truths in investing. Position sizing is the real holy grail of the stock market. Because no matter how good your analysis is, there will always be events outside your control. Wars, political shocks, and sudden macro changes introduce randomness. And when that happens, the difference between panic and peace comes down to one thing: how much risk you took in the first place. If your positions were sized correctly, you may be slightly red today, or maybe slightly green if you're diversified across multiple assets. But you won't be emotionally shaken. And that's the goal. Investing is not about constant excitement. It's about staying calm through uncertainty. Right now, the geopolitical situation has introduced a new layer of risk. And frankly, no one knows how long conflicts like these will last. History has shown us that what begins as a short-term event can stretch much longer than expected. From a macro perspective, one important positive signal is that the US dollar index remains relatively stable. Typically, when fear spikes globally, the dollar surges aggressively. The fact that it hasn't spiked dramatically yet suggests that markets are cautious, but not in full panic mode. Equity markets, however, are showing weakness. This is normal during periods of uncertainty, especially when institutional investors reduce exposure temporarily. These flows can create short-term pressure, even if the long-term fundamentals remain intact. This brings me to one of my most important personal rules. When the market is trading below its 200-day moving average, I do not add new momentum positions. Not because I know the future, but because I respect uncertainty. The market can always fall further than expected. Cash during uncertain trends is also a valid position. However, this does not mean long-term investing should stop. My long-term portfolio, the one I'm building for the next generation, continues its systematic investment plan. Because long-term wealth is built through consistency, not timing, and this is where diversification becomes critical. Energy markets have reacted, as expected. Oil prices have moved higher due to geopolitical risk, although not as aggressively as some feared. This is something we will continue monitoring closely. But the real standout assets remain gold and silver. Precious metals historically perform well during uncertainty, currency instability, and geopolitical stress. And that's exactly why I continue systematic investments in gold and silver. These are not short-term trades, they are long-term insurance against uncertainty. This creates a simple, structured approach. My long-term portfolio continues investing consistently. My momentum portfolio stays defensive and patient. And any capital exiting momentum positions remains in cash until market conditions improve. Because investing success is not about reacting emotionally, it's about following a process consistently. Periods like this test investors. But they also remind us why risk management, diversification, and discipline matter more than predictions. Stay calm, stay disciplined, and focus on the long term. This is Future Finance Lab. Take care, and I'll see you in the next update.